Shares of Uber under a little bit of pressure this morning, but the stock has been an outperformer year to date. It is facing a downgrade this morning. Canaccord downgrading it to a hold, moving to the sidelines. They've lowered their price target to $84 a share. Joining us for analysis of the chart is Rick Ducat, the Duke of Data himself, lead market technician here on Schwab Network. So, Rick, what do you notice about this chart for Uber when you think of the patterns?
Yeah, strongly outperforming the S&P 500, up 32% during the past 52 weeks, listed as part of the industrial sector, but pretty different from the other companies in that group here. And if we were to look more closely at our candle charts, we can see that Uber is at an important point in terms of its share price here. What I mean by that is we're knocking on the door of those old highs, 93.60. We made intraday highs beyond that point, but the bulls couldn't quite pull together a close that would get beyond that level here. So now we can see as well, there's some other important horizontal levels to consider. We had kind of this W-shaped price pattern after we hit those highs. We bottomed out near 82, our light green line here. Backtrack here. It matches up with our gap level, a high point, subsequent low points here. So one of these sticky price levels that traders often look for to help in strike selection or finding support and resistance.
What are you noticing about volume when you look at this chart?
Sure. If we were to look at volume here, we can see our volume profile study shows a node here kind of in the midst of our range. So around 84 could be important. We also see another smaller node here near about 91. So that could be a supportive area to watch if price does move lower. +2 standard deviation channel comes in up here above our current prices near about 96 or so. So keep that in mind for potential resistance going forward.
All right, so potential resistance levels to watch going forward. Let's bring in Tom White, senior options contributor and co-host of Fast Market. Tom, okay, so look, Uber hit a new all-time high yesterday. It's been an outperformer this year, especially if you compare it to its peer, far and away performing better than Lyft. What's the approach for an example trade? You've got some caution around it today.
Yeah, a little bit. And if you think this thing's maybe overbought, I mean, Rick kind of walked you through the technicals of this stock, so it's getting extended as far as a technical basis. And what does that mean when it's hitting all-time highs? Implied volatility levels get flattened here. So you see that vol crush as the stock makes, all-time highs. So I looked at a strategy. If you're a little contrarian, maybe you agree with the downgrade that we're seeing here today, this strategy takes advantage of that low implied volatility on a directional bias. If you're bearish, right? So this is just an example, but if you think this stock's going to fall, this strategy takes advantage of it. So we're going to look at a put vertical to the downside. We're going to go out to the August 1st weekly cycle on this. So we're going to give ourselves about 35 days in this position. And why do you do that? Why do you use the August 1st? Well, I use that to avoid earnings. They report earnings that first week of August. So this avoids it, but takes advantage of that low implied volatility. So August 1st, weekly options, 35 days to expiration. We're going to buy the slightly in the money 94 strike put, and then we're going to sell against that to offset some of the costs on this bearish trade, sell the 87 strike put. So in essence, a $7 wide bearish put vertical to the downside. You're paying roughly, if the stock opens up right here, about $250 debit. There's going to be your risk on this trade, $250 per spread. That it can expand to $7. So you got a pretty good risk reward setup on this. Break even on it, if you pay $250 debit, it's going to be $91.50 to the downside. That's only about less than 2% below the current share price. So you don't need that big move. And buying directional biased verticals like this gives you a lot of flexibility as far as trade management goes. Because of the fact that you're buying at a low implied volatility, if we get a pullback in Uber at any time over the next 35 days, it gives you that opportunity to maybe close a portion of it or all of your position if the price starts to expand to what you want it to get up to. So it gives you some flexibility as far as trade management. But I think the key on this one is it's bearish. You're taking a directional bias, but that low implied volatility allows you to pay less for this directional trade.
All right, that's a put vertical example trade there for Uber. Thank you so much, Tom.
Thanks.
That's our Tom White, senior options contributor.